And European option can be with call option, put option, and then there are other kinds of options that you've not even heard of yet. But in all options, there is the American variety, which means they can exercise up till and including exercise day, and the European variety, which means they can only be exercised on the last day. Okay. So now, when we talk about option pricing, what do you think? What do you think option pricing means, Shahrukh? What do we mean when we say today we are going to figure out how to price an option? What do you think that means? How to? Yeah, so let me just make this very explicit so all of you know what we are going to cover today. Let's say that this is a call option and we have underlying share is General Electric, strike price is 25 and maturity is 31st August. If you have this option, the right to buy the underlying for 25, do you think this option, you should get this for free, or do you think this will be worth something? It will be worth something. It is that worth that we are going to calculate today. That worth is generally denoted as a C. So if C is equal to 3, this means that this option, people are willing to pay $3 for this option. Okay. In the last class, we simply had this 3 as a given. But in this class, what we are going to do is come up with that price. How do we do this? Broadly speaking, there are two models and they are both rather complicated. So two models for coming up with option price. One is called the binomial approach, which we are actually going to skip in this class. So in a more detailed class on derivatives, you will get into the binomial option or binomial approach. All we'll do here is learn what's called the Black Scholes option pricing model. Okay. So the binomial approach, as I said, I'm going to skip. So there is like 3 pages in your book which you can ignore. All right. But we will talk now about the Black Scholes option pricing model. Before I get into the assumptions and a very ugly looking formula that you will see in 5 minutes, I want you to develop an intuition for what are the variables that will impact the price of an option. So let's say that we are still working with that simple option. So this is a call where the underlying is General Electric, one share of General Electric, strike price is 25, and the expiration date is 31st August. Okay, so what are the variables that will impact how much you would be willing to pay for this option? Okay, so yeah, Maddiha, right? Maheen, okay. Okay, very good. So which volatility of what? Of the underlying stock? So the volatility of the underlying stock is obviously one. Okay, so another would be how much time to maturity. Now, more time to maturity, more the value of the option or less the value of the option? More. So time to maturity is another critical element. What else? Yeah, so the type of option, true, but let's just say that we are working with European. In general, in our models, we work with European because they are easy to deal with. Wakar? No, Kamar. Yeah, so the current. So let's say that the price of the underlying stock. Why does that matter? Yeah, so obviously think of it this way. If the market price of the underlying share is $5, do you think this option will be worth much? No. But if the market price then magically goes up to 24, will the option be worth something? Yes. Definitely. So clearly the price of the option or price of the underlying stock also has a impact. Anything else? Actually the economic cycle will already have an impact on the stock price and the volatility. The other item which actually matters is the strike price. So obviously here it's already given, but if you have another option where the underlying is the same, but the strike price is 20. Will this option be worth more or less than the original one? It will be worth more. So the price of an option should also depend on the strike price. So the good thing is that we've developed an intuition for the core variables that impact strike price, that impact the price of an option. Why? What is more valuable to you? The option to buy the underlying cheap or the option to buy the underlying expensive? The value to buy, or if you have the option to buy something for 20, that option is clearly worth more than the option to buy something for 25, right? What if these were put options? Then it would be the opposite. Okay, so you need to think about what's going on. Okay, now just as a side remark, another variable that also plays a role is the risk-free rate. Okay, just take that as a given for now. Okay, now can you remember these 5? Especially the top 4: the volatility, the time, the stock price, the exercise price, and the risk-free rate. Towards the end of this lecture, I will give an explanation which is slightly unintuitive and complicated, and if you get it, great. If not, don't worry about it. Right now, just let's focus on the main ones. The impact of risk-free rate is very little anyway. Okay. So that is the first thing you've learned. What are the variables? The second thing that you need to learn is the assumptions of the Black Scholes option pricing model. So before we get into that long-winded formula, just need to know the assumptions. The stock underlying the call option provides no dividends during the call option's life. What do you think this means? Yeah, you are not getting dividends, and actually the assumption is made that the underlying stock doesn't pay dividends. Okay, that's one assumption. During the option life. So if you hold an option for half a year, you are assuming that during the option life, in this formula that we will see on the next slide, the underlying stock does not pay a dividend. What? It's an uncovered. So we are assuming here an uncovered option in the sense that we are valuing just the option. Yeah, so right now just assume you are not holding the stock, you are just holding the option. Okay. Next point is there are no transaction costs for the sale purchase of either the stock or the option. So as you might have noticed, these big shots who come up with complicated theories and formulas like to make very simplistic assumptions. And the point here is that as it is, when you see the formula, you will get a bit of a shock. So with these simplistic assumptions, you are going to get that shock. So imagine how complicated the formula would be if they did not make these assumptions. Now what happens in the real world is these assumptions are made to come up with a base sort of formula, and then one by one you can remove those assumptions and make the formula more and more complicated. But we are just starting at the base level right now. Okay, the risk-free rate is known and constant during the option's life. Is this reasonable or unreasonable? This is quite reasonable because the risk-free rate doesn't change that much. Most options have a short life. So in most countries, the risk-free rate obviously changes over time, but it doesn't change a whole lot in short periods of time. Security buyers may borrow any fraction of the purchase price at the short-term risk-free rate. Okay, so anybody can buy and can borrow money at the risk-free rate. Okay, just a couple more. No penalty for short selling. How many people know what short selling means? Okay, I'll just explain it I'll just give it to you very briefly, and then this is something you study in more detail in a securities analysis course. Short selling means that if you believe a given stock is overvalued, what you can do is go to your broker, borrow that share, and say to him, I'll give you back that share later. So you take that borrowed share, sell it at say $100, pocket the $100. 2 months later, if you are right, the share price comes down to 70. You go to the market, buy the share for 70 and give it to the broker. Say, I borrowed a share from you, you can have it back now. Okay, so what did you do in the meantime? You pocketed the $30 based on correctly speculating that the share price will come down. So this is called short selling. You can make money. What? Yeah, the broker will charge. There'll be, I just like gave you the simplified version of what happens. Call option can be exercised only on expiration date. So what sort of a option is this? This is European. Security trades take place in continuous time. Stock prices move randomly. Okay, now for the formula. Okay, so this, as I mentioned, is a little bit complicated. You do not need to memorize this formula. Okay, just a one slide correction to this formula. This bracket is over here. Okay, so that's an error that was identified in the last class. Okay, now before you get frightened, as I mentioned, you will be given this formula if I expect you to use it on an exam, and you just need to know how to use it. So to know how to use it, let us just plug in some numbers and understand what all the variables are. The value of a call option is given by V. So P stands for the price of the underlying stock. So if you have a situation where, excuse me, yeah, it is the current price of the underlying stock. So if you have the following option, you have a call option on GE shares where the strike price is 25 and the time to maturity is 6 months, expressed as 0.5 years. And let's say that the underlying stock, the price of the underlying stock is currently, let's say, $24, just as a example. Okay, now what is P? It's the price of the underlying stock. N is a normal distribution of D1. So this begs the question, what is D1? D1 is a number that's calculated over here. So D1, do you know what this means? This is your natural log. What's P? That's 24. What's X? So it's the strike price of 25. Plus what's this? Risk-free rate. Let's say that the risk-free rate is 0.05 or 5%. So you plug in 0.05. What do you think this means? This is the variance of what? Of the underlying stock. Remember that all the variables that we talked about earlier that will impact a call option value are showing up over here. So I expect you to know the variables, but I don't expect you to know this formula. The variance, let's say, is 100. So this is a measure of the variability of the underlying stock. What do you think? So this, instead of sigma squared, I have 100. What is T? The time to maturity in days, months, weeks, seconds, years. It will be in years. Okay, in all these option formulas, the time is in years. So that will be 0.5. So when you plug in these numbers, you will get a certain. What about here in the denominator? What's this? This is 10, the standard deviation, and the square root of time, 0.5. If you do the calculation, you will get a number for D1. Okay, so does somebody want to do this for me real quick? Okay, so some of you just quickly come up with a number for D1. Actually, can the free riders also just try to do some work now? Okay, copy the formula down. Okay, I'm going to have you use this formula on the next slide. So actually, this is a good time to copy the formula down too. How much? 3 point. So are you sure D1 is 3.5? So point of. Okay. All right. So anyway, let's for simplicity. What if let's just imagine? Let's just say, for the sake of this calculation, or to make the rest of the slide easier to explain, let's say that the numbers were such that D1 came out to be 0.5, just as an example. Now, what does this imply? What does N D1 mean? So what is N of 0.5? Do you remember what this N stands for? A normal distribution. Okay. So does that ring a bell? What's another name for a normal distribution? It's also called a bell-shaped distribution. Okay, so what does this represent? So the total area under this normal distribution is 1. So the 0.5 is the z value. Do you remember what z value meant? The z value is the value on this horizontal line. So what is this point over here, the midpoint of the bell? This is 0. So what is N0? Do you remember? N0 is all the area to the left of 0, which is 0.5. So N of 0.5 will be what? You find this line at 0.5. So roughly what do you think it will be? Yeah, it will be 0.6 or 0.7. So let's say that N.5 is 0.7. Make sense or not? This is just I'm sure you've studied this in statistics. Okay, so approximately 0.7. Okay, so now you know what ND1 is. Minus, what's X? That's the strike price of 25. Times E, that's your exponential, to the power of minus K. What's that? Minus 0.05 multiplied by what's T? Times 0.5. And what's ND2? You calculate D2 from here. So you calculate D2 from here and then you plug in the D2 over here and you will have ND2. Okay, so what I want you to do now is just to learn how to use this. Okay, so let's do this. Can you take these numbers down? So we are going to actually find the value of this option. If the underlying price is 27, the strike price is 25, risk-free rate is 6%, 5 years to maturity, and the variance is 0.11. All right? So you got the numbers? Okay, now use those numbers to come up with the value of that call option. So essentially you are going to use the Black Scholes. What? So what was the strike price? What was the current stock price? What else do you have? The variance was, and what's the risk-free rate? Anything else that you need? And the time to maturity is 0.5. Okay, so this is actually fairly mechanical. So let's see if you can come up with how much and remember the formula, this is like that. No? Okay, so if I give this to you on an exam, I will also give you the normal distribution. So here is what you should get. So you get D1 and you get D2. Does it make sense that ND1, so if you have your normal distribution, okay, so where is the D1 coming? The D1 is 0.57. So the ND1 is this area, which is clearly more than 0.5. It's about 0.7. Does it make sense that if D2 is 0.3, then ND2 is also more than 0.5? Does it make sense, or is there a mistake over here? Why does it not make sense? I set up a small trap for you and you fall right into it.
It was 0 in the center.
Exactly, it's 0 in the center. So any Z, do you remember that these D1s are really Z values? So if the Z value is greater than 0, your ND will be greater than 0.5. Okay, so you see how to come up with these. What will you do next? Now can you copy down these numbers, 0.7 and 0.6? So this is 0.7 and this is 0.6. Now can you come up with the value of the call option? Yeah, so what you should get is approximately $4. So what this is saying is that the price of an option with a strike price of 25, when the underlying is 27, is $4. Now, Serish, what will happen to this price if the stock price goes up? Let's say you buy the option for 4 based on your usage of Black Scholes, and then the next day the stock price goes up, is your option worth more or worth less? It's worth more. So you can then again use Black Scholes to calculate the new price. So if you want to sell it to Haneen on the next day, you will sell it at a higher price because that option, the option is still giving the right to buy the underlying for 25. Now that the stock price has gone up, that option is worth more. What if there is economic uncertainty and all of a sudden you perceive the volatility of the stock has gone up? What will happen to the option will, does that mean that the stock price has gone up? Not necessarily, but if the anticipated volatility is up, that means the option will be more valuable. Okay, risk-free rate is not changing. Okay, so when you solve for the option value, you get about 4, which we just did. All right, now I want to, so this actually up till now things were mechanical. Now let's see if we can solve or do something intuitive. So what are the variables that impact a call option value? So if we are talking about a call option, one is stock price. Okay, so in your name in the pink shirt, Shoaib. So if the stock price goes up, what happens to the value of a call option? The value of a call option goes up. Okay, ये बहुत बुनियादी अच्छा सवाल है. So the question is, he bought the option for 4 under the circumstances that we discussed earlier, and then later the stock price went up. So the question is, so the point is that the option is a piece of paper that you have that contract, the right to buy for 25. Is that right more valuable now? या तो यानी कि अब अगर आप वही ऑप्शन किसी को बेचोगे तो वही 4 का बेचोगे कि मैंने 4 का खरीदा तो आप भी 4 का ले लो. हाँ, so you're doing finance, not charity, right? So you are going to sell it now at the new market price, correct? And how will you figure out the new market price? Again, you will do Black Scholes and you will now plug in the new numbers. You will plug in the higher stock price. Okay, so and then you'll figure out the new price and that's what you will sell it for, right? Okay, just as a side remark, at banks or other financial institutions that have options, in accounting you might have studied something called mark to market. So what that means is your various assets and something like this might be a non-balance sheet item. These need to be marked to market. Yani ke if you bought something for 4 and now the value is more, you have to now show it at the new value. So stock price goes up, the value of the call goes up. What if the volatility goes up? Then what happens? Saira, why? So do you agree, Aisha? Why? What are we talking about? The price of what? Yeah. So if the underlying stock, now this is the volatility of the underlying stock. If the underlying stock is more volatile, is the call option more valuable? Yeah. Why? Exactly. So if the underlying stock is becoming really volatile, the chances of your making money are more. Actually, let's say, so I'll answer this briefly, otherwise we'll lose the whole class, most of the people over here. So the point is this, clearly the value of a call option depends on the volatility of the underlying, right? And what Black Scholes tells us is that the way you account for volatility of the underlying is through these numbers. Now, are we assuming that the volatility of the underlying does not change? That is not one of the Black Scholes assumptions. So if 2 weeks later, all the other variables have stayed the same, except obviously for time, and volatility has gone up, then you calculate the new value of the option using the higher volatility. And one thing that you can do in your spare time is, we just calculated this number. Now assume that the volatility goes up from this number to 0.22, and you will miraculously discover that the value of the option will now be more. Okay, so that's the basics. Now getting into more detail is either an after class discussion or even an after course discussion. Okay, so anyway, so volatility of the underlying goes up, the value of the option goes up. What if the time to maturity is more? So two options similar, except one has a higher time to maturity, the other has a lower time to maturity. So the call option will have more value. What about the exercise price? So if the exercise price is higher, will a call option be worth more or less? Asim, try to get Muhammad Ali. What will decrease and why? Yeah, if the call option, if the strike price is higher, the value of the call option would be less, because the right to buy at a higher price is less valuable. Okay, now what I want you to do, so we've done this analysis for a call option. What I want you to do is, for these same variables, tell me the up, down or the direction for a put. And this, if you can do this right, that tells us whether your understanding of this is there or not. So for each one of these variables, what's the impact on a put? Do you understand the question? If the stock price goes up, what happens to the value of a put? So make a small table. I'll just explain and we will move on. Okay, so now for a put option, if the stock price goes up, is a put option becoming more valuable or less valuable? Less valuable, because with a put option you want the stock price to go down. If the stock price is down, then the right to sell at say 25 is more valuable. Okay, so what if the volatility of the underlying goes up? Then a put option is more valuable, because higher volatility also means that the chances of the underlying becoming low or cheap is higher, and hence the probability of making money is higher. If a given option has more time to maturity, then that option is going to be worth more regardless of whether it's a put or a call. When you buy a put option, why do you buy a put option? Because you are expecting the stock price to go down. Now, is that more likely to happen if you have 3 months to go or 3 days to go? 3 months. So the more time to maturity, the more valuable an option, no matter what. Okay, as you get close to maturity, the value of an option will come lower and lower. Okay, what about the strike price? For a put option, the value of a put option becomes, is it more valuable at a high strike price or a low? So the value of a put option increases when X goes up, because high X means you have a right to sell at a high price. Huh? Okay, so if X goes up, that means that the put option is more valuable. Okay, so now, so this is another high probability item on your next quiz. In addition to payoff diagrams and profit diagrams, you are also likely to, I like this because it tells us whether you really understand this or not. Okay, all this is, okay. Now, okay, so now let's, so we are coming to the last segment of this chapter. One of the things I mentioned at the start, of this, when we started options, is that options allow you to manage risk. So let me give you one classic example. Let's say that you buy a stock for $30, and now when you buy the stock for $30, what's your risk? The risk is that the stock price will go down. Okay, now one way, let me check your understanding here. Given what you've learned about options, you've learned about two basic options. To manage your risk, or to control your risk, or to minimize your risk, what option would you go with? Let's say your different possibilities are, you go long a call, you go short a call, You go long a put, or you can go short a put. Okay, A, B, C, D. Which of these positions would you take to minimize your risk? Okay. So if you go long a call, have you reduced your risk? No, because when the stock goes down, you lose money. Okay, if the stock goes down to, what's it? What we are discussing is risk management. Okay. Okay, okay, so why don't I give you the pleasure of being in my shoes for a minute here. Okay, so I started, this is a short true story. Okay, so I got done, I was sitting where you are sitting in the, 1991. Then I joined a company called Oracle in 92. And this was, the 90s were boom years for the technology industry. So I just, no credit to me, I just lucked out. I was at the right place at the right time. So all of the 90s, the technology companies and technology stocks did brilliantly. So I was at Oracle, and like most other people at Oracle, every month I would get shares of Oracle. So the share price kept going up, 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 up. So that's all we saw. Okay, so all the extra money I had, stupidly, not thinking about diversification, I would just put it in Oracle stock. And that worked great. The stock price literally started split adjusted $2-3 and went up to $150. Okay, when I was leaving Oracle in 1999-2000, stock price was very high. Okay, I had not seen a crash, so I didn't know what that looked like. So, plus I hadn't studied finance, so I'd started studying, but the benefits of diversification and not putting all your eggs in one basket was just too theoretical. Okay, so sure enough, what happened in 2000 is this technology bubble burst, and stocks of Oracle and Microsoft and Cisco and Intel, they came crashing down. The NASDAQ index, which is generally technology heavy, went up to about 5,000, and then it came crashing down to like just over 1,000. And to date, more than a decade later, it's still not reached that same level. Okay, now, had I been smart and sensible, one of the things I could have done is I could have bought put options on Oracle stock, long put. Now, if I bought, let's just hypothetically say that the stock price was 30, and I paid $2 for a long put. Okay, and then after that, the stock price came down to 10. Okay, if my portfolio consisted of the stock plus a long put, and the stock price came crashing down, what would my situation be? So my stock would be worth how much? 10. And would I benefit from the long put? Yes. I would benefit how much? So if the strike price of the put was, say, equal to the initial stock price, how much would I have benefited from that? $18. So from 30 down to 10, so the payoff would be 20 and the profit would be 18. So the 20 that I lost over here, I would have made up on the put, but I didn't. Okay, so I lost a ton of money, and I had that loss. But somebody who does the strategy, do you see how he is managing his risk? So this is an example of a risk management strategy of options. What is the only downside? The $2 that I would have paid for the put option. Now, this is essentially like an insurance, right? The $2 can be thought of like insurance premium, which is helping insure me against losses. What do insurance companies do? You pay them a premium, and then if you have a loss, they, at least in theory, compensate you for the loss. So that's what the put option is doing. So this is a classic example of a risk management strategy using put options. Okay, so that's one important point. Now, what I'm heading towards is actually explaining a core concept in options, which is to show that the value of two possible portfolios, one portfolio which is the stock plus a put, is equal to another portfolio which is a call option plus cash. Okay, now I'm going to show to you how these two portfolios are equivalent. Okay, let's say that you buy a stock and you also buy a put option on that stock with an exercise price of 30. You buy a call option on that stock with a strike price of 30, and you keep cash 30. So this is portfolio 1 and this is portfolio 2. And I'm going to prove to you that these two portfolios are identical. Okay, now how will I prove this? Let's say that you invest in this portfolio at time t equal to 0, and this portfolio matures 6 months later at time t equal to 0.5. Broadly speaking, there are two scenarios at t equal to 0.5. Either the stock price is going to be greater than 30, which is the strike, or the other scenario is what? The stock price is going to be less than 30. So for both these portfolios, let's see what happens if the stock price ends up being greater than 30. And just to pick a number, let's say that the stock price ends up at 45. Initially, let's say the stock price was equal to 30, and over here the stock price has gone up to 45. What's the value of portfolio 1 at maturity? How much is the stock worth? Okay, so ignore the put premium for now. What is the put option worth? Is the put option in the money or out of the money? Out of the money. Put option, you make money when the stock price goes down. So the put option is worth nothing. Okay, so what's the total value of portfolio 1? 45. What's the total value of portfolio 2? So this, no, I'm sorry, Umar, no, just wake up. Okay, Iqbal, if the stock price ends up at 45, how much is portfolio 2 worth? What's the call option worth? 15. And how much cash did you have? So what's the total value of this portfolio? 45. So notice that if the stock price was 55, would the two portfolios be the same? So no matter how high the stock price goes, the two portfolios are the same. So I'm telling you that I define this portfolio as a call option plus cash. Okay. Now what's the other scenario? So let's in red, let's say that the other option is that the stock price goes down. So what if the stock price, pick a number, what does the stock price go down to? Okay, so let's say stock price goes down to 15. What's the value of this portfolio 1? Taha? Stock price goes down to 15. What's the value of portfolio 1? How much is the stock worth? 15. How much is the put worth? So what's the portfolio worth? 30. What about on the right hand side? What's the call option worth? 0. What's the cash? 30. So what's this portfolio worth? 30. So notice that no matter what happens, portfolio 1 and portfolio 2 are the same. So can we write this equation down that the stock plus a put is equal to a call plus cash? How much cash? The same as the exercise price. And also note that this call and put are on which stock? Any stock or this particular stock? Or the call and the put are on the same stock. Do they have the same exercise price? Equal to X, which is the cash that we have. Now the reason we are doing all this thing, by the way, is called put call parity. Put call parity. And how can you remember this term? So, okay, can't argue with that. All right. So put call parity. There is this. What does parity mean? Equality. So notice that one portfolio has a put, the other has a call. You add a stock on one side, cash on one side, and you create parity. Okay, though PCP might be a better way of remembering it. Okay, just let me finish. Okay, so now let's, how do you figure out the value of a put option? Assuming you can use Black Scholes to find the value of a call option. So if the value of a call option is $4 and the underlying exercise price is 25, the stock or the price of the price of the stock currently is, let's say, 30. Can you find the value of a put? Yeah, using this formula you can easily now find the value of a put. So we don't need another complicated equation to find the value of a put. You can simply use put call parity to find the value of a put, given that we already have a complicated formula for the call option. Okay, now I can take questions. So Sadiq. Okay, so what's the use of this? Just think of this right now as a theoretical construct. You can create what's called synthetic options out of this. So it's a more advanced topic. Right now you're just understanding the basics. Okay, now have you understood this part so far? This is the basic. Now let me just show you in the, now can the put option be negative? The put option cannot be negative. Let me just give you one more. So those of you who actually try to read the book explains this in a slightly more complicated way. So I'll just also tell you what the book is doing. Okay. So far we've established this, right? Let me just check whether you are with me. So some Sidra. So what's the put call parity formula? So the stock plus put is equal to call plus cash. Okay, what's the amount of the cash? So it's a strike price, so let's just call it X. Now, another way of looking at this X or cash is what you really need at maturity. Okay, so in the examples that I gave, the amount of cash was coming in useful at maturity. So if the life of this option is 0.5 years, then at time 0, do you need X or do you really need the present value of X? You need the present value of X, because let's say that the rate is R, then having X is the same thing as saying X over 1 plus R to the power of what? 0.5. So this and this are equivalent. It's just the time value of money. So then this formula can be rewritten as stock plus put is equal to call plus X over 1 plus R to the power of T. Right? Now, taking this one step further, what if we assume continuous compounding? When we assume continuous compounding, then the present value becomes X into e to the power of minus RT. Now, if you get that, great. If you do not, then go back and revise your maths. Okay, so the present value of this using continuous compounding is written like this. So another version of this formula is stock plus put is equal to call plus X times e to the power of minus RT. So that's just assuming continuous compounding. Okay, now typically this number, given a relatively small r and given a short period for the stock, this will generally be close to 1, which is why my earlier approximation wasn't a bad approximation. So e to the power of a small number is what? It's generally not a small number, it's close to 1. Okay, anything to the power of 0 is 1. Okay, hopefully you remember that. Alright, now based on this formula, what's the value of a put? It is a call option plus X, and then let's ignore that for a minute, minus the stock price. So that's how you can come up with the value of a put. And this will always be positive. So if it's coming out to be negative, you've done something wrong. Okay, the formula is such that it will always be positive. Okay, so this concludes what we needed to do on this chapter.